Wow, what a good news. Madam, look at this. I made some profit.
Wow, easy money lah.
Yeah, now I can buy everything I want. iPhone, handbag, makeup.
Hey, not so fast.
Capital gains tax or CGT is a tax charge on the profit made when a person sells an asset such as shares, property, or investment for more than the original purchase price. The main reason for introducing CGT is to make the tax system fair. People can earn money not only from salaries and business but also from the increase in the value of their asset. Since these gains increase a person's wealth, the government believes they should also be taxed. Another reason for CGT is to reduce tax avoidance. Without CGT, some people may try to classify their income as capital gains instead of normal income to pay less tax. CGT helps prevent this and ensure everyone pays their fair share. CGT also helps the government collect additional revenue, which can be used to fund public services and development projects. Problem the tax authority is trying to solve is the first one is CGT helps to create fairness between people who earn income from work and those who earn income from the investment. And second, it broadens the tax base by taxing increases in wealth from assets that have grown in value. The third is provide extra revenue for the government to support public spending and national development.
Nani, I sold my shares in a private company and made huge profit, but I didn't know that we have capital gains tax.
Oh, it's okay. I can help you with that. What do you want to know?
Actually, that got me thinking, who exactly needs to pay the capital gains tax?
Good question. Let me explain to you. CGT mainly affects companies, limited liability partnership, trust bodies, cooperative societies, and also certain foreign investors.
So, ordinary individuals are not the main target?
Not under the current CGT regime on unlisted shares. If you are wondering, the main asset that is subject to CGT is unlisted shares, meaning shares in companies that is not listed on stock exchange or also known as Bursa Malaysia.
Only that?
There are others too. For example, shares in certain foreign-controlled companies that own substantial Malaysian real property as well as certain overseas capital assets.
Interesting. What about the tax rates?
If the shares were acquired before 1st January 2024, the taxpayer can choose either 10% of chargeable gain or 2% of gross disposal value. However, if the shares were acquired on or after 1st January 2024, then the rate will be 10% of chargeable gain.
I see. Thank you for explaining. I just realized I have no idea how to report this case.
Don't worry, let's go through the compliance process. First, determine the disposal date.
How?
Usually, it's the date stated in the share sale agreement. Next, calculate your gain using this formula. Disposal price less acquisition price, and you must include any allowable expense or incidental costs.
Can you give me an example?
Sure. Suppose you sold the shares for 500,000 ringgit. You originally bought them for 350,000 ringgit, and you also incurred a 10,000 in allowable expenses. Your chargeable gain will be 140,000 ringgit.
Then I apply the tax rate to that amount.
Exactly.
What happens after the calculation?
You need to submit a capital gain tax return form through eCKM in the MyTax system.
What about the deadline?
The return and payment must generally be made within 60 days from the disposal date.
How do I pay?
Through Bayar Hasil.
What if I forgot to submit it?
Failure to furnish a CGT return without reasonable reason is an offence. The IRB may impose a penalty up to 3 times the tax payable.
3 times?
This is why compliance is important.
What if I make a mistake in my return?
You can amend the return within 6 months. However, if any additional tax become payable, there will be 10% penalty may apply.
What if I accidentally paid too much?
You may claim a refund under mistake relief in section 131. And you must also submit a form CP 15C together with your explanation.
Is there a time limit?
Yes, within 5 years from the expiry of your return submission period. And if I disagree with the assessment, you can appeal to the Special Commissioners of Income Tax using Form 2.
We have discussed who is affected by CGT and how taxpayers comply with it. But why is Malaysia putting so much effort into adopting international tax standards? Because taxation today is no longer limited by national borders. Multinational companies operate in many countries, and individuals can hold assets and bank accounts around the world. Without international cooperation, tax authorities may struggle to identify income and wealth that are moved across borders.
So Malaysia cannot work alone?
Exactly. Before adopting international tax standards, Malaysia faced the risk of being classified as a non-cooperative tax jurisdiction by organizations such as the Organization for Economic Cooperation and Development and the European Union. What would happen if that occurred? Malaysia could face reputational damage, reduced investor confidence, and possible defensive tax measures from other countries. This could negatively affect foreign direct investment and international business activities.
That sounds quite serious.
It is. That's why Malaysia adopted global tax frameworks to ensure transparency and strengthen trust in its tax system. Now let's move on to the objective of international tax standards and how Malaysia puts them into practice. The first objective is to protect Malaysia's taxing rights. In today's global economy, some multinational companies may report their profits in countries with lower tax rates, even though their actual business activities take place somewhere else. To tackle this issue, international initiatives such as the Base Erosion and Profit Shifting or BEPS framework help ensure that taxes are paid where the economic activities actually happen and where value is created. This helps prevent profit shifting and protects Malaysia's tax revenue. The second objective is to combat illicit capital flight. In the past, some individuals could hide their assets in offshore financial centers and avoid reporting them to tax authorities. To increase transparency, Malaysia participates in the Automatic Exchange of Information or AEOI and the Common Reporting Standard known as CRS. Through these systems, tax authorities from different countries share financial account information with one another. As a result, it becomes much harder for people to evade taxes and hide assets overseas. The third objective is to enhance domestic revenue mobilization. In simple terms, the government wants to improve tax collection so that it can generate enough revenue to fund important public services such as infrastructure, education, and healthcare without having to place additional tax burdens on ordinary citizens. So how does Malaysia implement these standards? Malaysia has incorporated them into several legal and regulatory frameworks. For example, the Income Tax Act 1967 serves as the foundation of the country's tax administration system. In addition, AEOI and CRS regulations require financial institutions to report certain account information. Malaysia also introduced the country-by-country reporting rules 2016, which require large multinational enterprise groups with annual consolidated revenue of 3 billion ringgit Malaysia or more to disclose information about their global operations. This helps tax authorities identify possible profit-shifting activities and improve transparency. Overall, these measures have strengthened Malaysia's position in the global tax landscape. They help increase investor confidence, promote transparency, and support long-term economic growth. With developments such as the global minimum tax under BEPS Pillar 2, Malaysia's competitiveness now depends more on its real economic strengths, such as its strategic location, quality infrastructure, skilled workforce, and stable business environment. In conclusion, capital gains tax was introduced to make the tax system fair, reduce tax avoidance, and generate additional government revenue. It mainly affects companies and certain investors that dispose of taxable assets, especially unlisted shares. To comply, taxpayers must calculate their gains, submit the required tax return, and pay the tax within the prescribed deadline. At the same time, Malaysia's adoption of international tax standards strengthen transparency, improve investor confidence, and enhance the country's reputation in the global economy. Overall, these measures support a fair, efficient, and sustainable tax system for Malaysia.
One is the loneliest number that you'll ever do.